Welcome to Weekend Wisdom. Today we're going to discuss, is it a good idea to take a loan from your 401k? So grab your cup of coffee, sit back, and let's get started. Hello, this is Michael Loftus and welcome to Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget below you can click show more for additional information and links on today's video. Also, if you're looking for a different opinion than you see on big TV in Wall Street, please do consider subscribing. So the question today, does it make sense to take a loan from your 401k? So first off, where does it make sense? Emergencies. I think that's really the only case. Medical reasons. This is one of those reasons why you might need to take money from your 401k. Other than that, it's difficult. So let's go through a couple things. First off, you need to find out if your plan even allows loans, which is considered a loan provision, and that can be found in the plan document. Of course, you may not know where that is, so you have to go to your HR director, or with smaller companies, whoever is in charge of the 401k, obviously one of the owners or an accountant within the plan. Also, the financial advisor as well. So after that, the problem with loans, they can be very expensive on a percentage basis. When you look at a 401k, there's generally three parties to that. The custodian, that's who hold the assets, third-party administrator, and they take care of filings, loan provisions, things like that, and then the advisor. So in this case, it's not that there's advisor fees, but there's going to be fees from the custodian and the third-party administrator to set up that loan, to put it out, to take care of the paperwork, etc. I've seen as high as $300. And then you look at the cost of the loan, because you're going to have a regular interest rate on that. And it depends on where you are, the LIBOR, etc. But when you get that together, I mean, I've seen as high as 8–9% for loans. Really, really high when you amortize that over a few years. So from that standpoint, it does not make sense. It's so costly to get. The next thing is lost opportunity costs. What is that? Well, think about it. If you take out 10, 15, whatever from your 401k, you're going to lose that opportunity to be invested, to be in the market. So you're going to lose that, so the potential to grow. So not only are you losing the potential to grow, but you've taken those dollars out. So really worried about that as well. The next thing is, if you leave your job, that loan is going to have to be paid back all at once. If you cannot, really got to be careful here, because you're going to have taxes. If you're pre-59 and a half, you have a 10% penalty plus taxes on that. Really, really can be expensive. So you have to be careful there as well. So overall, does it make sense? No. No. No, no, no. Please, make sure you get good sound advice. I see very limited circumstances where it makes sense. And when I set up 401ks now, with some of my clients, we generally don't even add a loan provision because of the problems that it can create. So the question is, where does it make sense? I think there's one area here. We talked about obviously medical, but there's another area here in what's a different 401k. So you have a 401k, and if you're a small business, what I've seen is clients that have gone from, say, corporate or bigger companies, and they've started their own company. Well, you can roll that money into an IRA, or you can roll it into what's called an individual K. And in an individual K, Indy K for short, you can have generally a husband and wife. That's it. So it can only be family members in this plan. So if you have employees, it does not work. So going back, if you roll into an IRA, there's nothing you can do with that money. If you take it out, you have to replace it in 60 days or pay taxes and penalties depending on your age. But on an individual K, you do have a loan provision here. So a couple things you need to consider. First up, has to be paid back within 5 years, number one. Number two is you have to have a regular schedule amortization. The loan rate has to be reasonable based on regular commercial loans right now. And the maximum you can do is 50% of your individual K balance, not greater than $50,000. So I've seen small business owners, new entrepreneurs take advantage of that to help them with some upstart cost, furniture, whatever the case might be. One thing you need to consider, if you do default on that loan, if you took out 50, you've only paid back 30, that 30 can be taxable just like the other loan, so penalties, taxes will hit you there. So wrapping things up again, if you want to take a loan from a 401k, I think the cases it makes sense, medical reasons, individual K. Other than that, I do not see it making sense. Thanks so much for watching. This is Michael Loftus for Wealth and Wisdom TV.